Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Mark Mascia. Thanks for being on the show, Mark.
Thank you.
Mark has over 17 years of real estate experience and has a portfolio valued at over $1.5 billion. He started Mascia Development LLC in 2006. Mark has 2 master's degrees from New York University and George Washington University. Mark has a very healthy educational obsession with his hero, Warren Buffett, who most of you have probably heard of, and contributes his skills at conveying concise, meaningful messages to any audience to studying Mr. Buffett. So, Mark, thank you again for being on the show. I appreciate your time and sharing your expertise. Give the listeners a little bit more about who you are and what your focus is right now.
Yeah, no, great. Thank you, Whitney. I appreciate being here. So I think the intro is a pretty grand entrance, but it's sort of pretty straightforward. I mean, I studied and got my master's degree. I worked for a lot of large publicly traded companies doing a lot of large deals, but was never really satisfied kind of working for someone else. It was very frustrating for me as an individual. And so I learned a ton, but kind of used that to start my own company as mentioned. And since then, so for the last 13 or so years, I've been focused on working with a lot of large family offices, wealthy individuals, and syndicating those capital sources out into the retail, medical office, and multifamily space nationwide. So I think we've done deals in about 13 states, and we own, the portfolio you mentioned. So it's been very lucky.
Nice. So, you and I had talked a little bit before the show about something you've been working on for a long time. And I thought, it'd be great for us to be able to dive into that and share some of the things you've learned and why you all have chosen this route. And that's, you all pursued a Reg A offering, correct?
That's right. Yep.
And could you just, why don't we start? Could you just elaborate a little bit about what that is? And
Sure.
then, obviously I'll have some more questions about it.
Yeah, no, great. So I'm assuming, although just so we're on the same page, most people have probably heard of the 506C or 506B exemption, which is kind of the traditional quote unquote way of raising money, which is high net worth, accredited investor only type product. There's some limited exceptions, which I won't get into now, but essentially just for, easy use, that's what it is. We had experienced a lot of challenges, even though we work with some of the largest family offices and some of the wealthiest people in the country. We did have a desire to expand our capital source beyond just a small select few families or a small select few individuals. And in order to do that, we were getting tons of people who were just on the cusp of being accredited or not. And we essentially had to 100% say no to all of these people. And that list started growing. In the beginning, it may have been a handful, and now it's over many hundreds of people that are on the cusp. So, if they live in a lower cost of living area, but they make $200,000, but not $300,000. Well, in that community, they're very wealthy, but according to the government, they're not wealthy enough. And so we felt like there was an opportunity there to do the Regulation A offering, which is a much more involved upfront offering to go through the SEC and actually get a formal review process with them, the federal government, instead of the state regulators, which really deal with the 506C exemptions. And going through that process now allows us to access capital from anyone. So there's no restriction on income. There's no restriction on, really anything that anyone who wants to invest can invest, as long as it's not a, drastically significant portion of their net worth or income.
Okay. So is that, that's the biggest reason you all chose to pursue a Reg A, so you can allow anyone to invest, correct?
That was the predominant driving factor. There are some other ancillary benefits as far as ongoing operational costs and kind of we plan to use this as an evergreen structure, so a fund that stays open essentially forever. And there were some operational efficiencies with going this route, and the long-term viability of it being, in our mind, essentially a publicly traded company in the long term. So there were some pathways here that using the Reg A structure helped, but definitely the primary focus was allowing everyone to invest, yes.
Okay. And so you mentioned, much more involved going through this formal review process. Could you just, give us a little window into that process and maybe in a little bit of what's involved, or if we're thinking about pursuing something like this, what should we expect?
Yeah, great question. And I think, Whitney, just a baseline to understand. I mean, I'm not a lawyer, so nothing I'm giving you here is
Sure.
like legal advice or whatever. But I will
Go
say
talk to
on the
your own
flip
lawyer, right?
exactly. But on the flip side, I'll say I'm very, very detail oriented, and I follow the rules very explicitly, especially when it comes to the government regulators around securities offerings. I've just heard and seen too many horror stories to not do it. So, in some ways, the 506B process and the 506C process is actually almost the same, because you have this document that you have to create with the lawyers that's about 50 plus pages of all the ways everyone's going to lose all their money and that I'm a terrible person and you should never do business with me, right? Like that's the document that the government wants you to create and make investors aware of. And really both cases, that's what you're doing. One, on the Regulation A side, it's a little bit more involved, it's a little bit longer, it's a little bit more onerous in terms of how horrible you have to make yourself sound. But they're both pretty similar in that respect. The back and forth process and kind of the learning process for us was a big problem. I mean, when we started doing this 3 years ago, going through the process, really only 2 other companies had ever even applied, let alone been approved. So no one had really been approved by the time we went through the process. And so a lot of it was teaching ourselves, teaching our attorneys, teaching everybody what kind of the process was. So I think in retrospect, going back and having to do it all over again, it wouldn't be quite as onerous as it was for us, because now there's kind of a more clear path. But it's certainly like you're dealing with an actual submittal to the government that the government has to read, review, and respond to, and then you have to respond to those comments. Whereas in the traditional 506C process, you submit whatever the heck you want, and the government says, okay, and as long as you don't ever get sued and whatever, they don't ever pull out that document and look at it. They only use it as a punitive measure, looking at it after the fact. Whereas the SEC actually had to go through and read our submittal document, comment back on it, and we had to comment back to that process. So it was a much more, it wasn't crazy involved, but it was a lot more involved than sort of just the submit it and you're done kind of process.
All right. So you mentioned that, obviously one pro is that you can take capital from anyone. What other pros are there to, going through this process?
Well, there's no liquidity restrictions. So in the traditional 506C, and again, I'm not a lawyer in all the rules, but there's restrictions on timeline that the government imposes about transactions. So you can't immediately turn around and sell those for a period of time. That's not true with the Reg A process. So if someone buys it today and they want to sell their shares to their brother tomorrow, they can do that. So there was some liquidity concerns that we have. I mean, our investment structure is long-term. It's mainly focused on people who want money to be invested for 7 to 10 years or longer. And that's why the family office aligns so well, because most of those are multi-generational investors, 10, 20, 30 years or longer. But there is always seems to be, no matter who you are, no matter what your time frame for investing, there always seems to be some surprise where, death or whatever, that you need liquidity. And so this allowed for a lot more options for liquidity than a traditional 506C fund would have offered. So that was the other big benefit, is you have essentially unrestricted time frame to sell and unrestricted people. If they find, their cleaning lady wants to buy their shares, they can sell it to them, or whatever the case may be. It's not, there's no hindrance to them on liquidity.
Okay, well, you probably know my next question, or what are the cons of doing this? Of a Reg A?
Yeah. So the cons that most people refer to are transparency. You have to be, as transparent as a publicly traded company for the most part. So there's nothing, I hear all the time people say like, oh, I have this like proprietary this or this proprietary that. And, like we have a proprietary financial model or review process. We have some things like that too. So I'm not worried about those things getting out. Those things don't have to be disclosed, but like any deal we're working on has to be disclosed, and kind of throughout that process, how that goes. Our quarterly financials have to be reviewed and audited on an annual basis. So there's a lot more like kind of looking under the hood of the operations of all of this, which can be scary to some people, if they're, I'm not saying that they're hiding things, but just some people just don't like their business being out there in the public for everyone to review, especially if they're not investors of theirs, meaning anyone can review. You guys can go on and review my fund on the SEC website, even if you don't invest. And some people don't like that. So there's definite downsides to that. I don't view that as a downside. I'm a very open and honest person, and I run my business the exact same way. So to me, that's not a downside, but I could see how others would see that. And then the other is operationally, it's a little bit more onerous because you do have to do audited financials. So in the past, we had never done that because we didn't really see the value, and none of our investor partners required that. Now the government requires it. So whether anybody gets value out of that or not, we have to do audited financials. So from a transparency standpoint, that's great. It's one more transparency level that people can feel confident that we're reporting things in an appropriate way and someone else is reviewing that to approve it. But from a cost standpoint, I mean, I don't think anybody's looking at this and saying, oh, you got these audited financials. Now you're like a much more, legit thing. No, I don't think the value's there, but the government requires it. So we're like, fine, we do it,
Of course. So, when are we ready to pursue something like that? So, I've been syndicating for a while. I've done numerous deals. When am I ready to pursue something like a Reg A or exemption? Or why would I do that? Or not? Well, you've already answered why, but when? When would I or should I think about something like that?
I think it's another great question, Whitney. I mean, I think there's no perfect answer. I mean, I'm not even sure we were totally ready when we did this. So I think, it's always a bit of a chicken and the egg thing. I mean, I think the one thing I will say for sure is like early on, we did a similar thing and we were kind of blown away by how much harder it was when you don't have a track record and you don't have history and you don't have existing investors that are just going to kind of come in. I think a lot of people that have done Reg A's and have failed, from what I've heard from my attorney and other people, is that they expected it to be the kind of like, windfall thing where all they had to do is come up with this structure and people were banging down their door to give them money. And it certainly isn't that. And we weren't expecting it to be that. So I think, you have to be ready to go the long road. It took longer than it's supposed to take 6 months to approve. It took us 3 years. So we had to be patient for that. So if you're looking for this to do your next deal in 3 months, it's not going to be good for that. Right. And the same thing with the capital flow coming in. I mean, almost every single one of our investors in the current fund was an existing investor. So there was very limited kind of people banging down the doors, looking to get in. I expect that to change over time, but I'm being patient. I'm not expecting it to be something where, hundreds of millions of dollars flew in from people I had never met before because they were available online. That's not what it's for.
So how was this perceived by those investors? So, I think it's great that you mentioned too, that the investors that invested in this were already investors with you. And, Al, we talked about when are you ready for this? Well, it's when you have that track record already, right? And you're already an established company. And so you're ready for it to take 3 years if it has to.
I mean, like I said, I think that's right. Exactly like you said, Wendy. I mean, it doesn't have to be that way. I'm not trying to discourage anybody from trying to do this if they have no track record. I just certainly think it could be successful. I just think, it's a lot harder of a road to hoe if you are sort of like saying, oh, this is my first time ever and I'm going to go do this $25 or $50 million Reg A fund. It's possible. Definitely not zero chance. It's just a lot less likely, in my opinion, than if you had a track record of a bunch of existing investors who told you they want this structure, which is what the case was for us.
Yeah, well, you don't get a portfolio of over 1.5 billion without some kind of track record, right?
Yes. Well, luckily we have partners and others that, have a little bit more gray hair than me, although I'm getting more every single day. So yeah.
So how was this perceived by investors? Since they were already investors of yours, what were, maybe questions that they had, or were they excited about it? What were their thoughts about, or how they perceived this?
Yeah, it's funny. I mean, I feel like, it was kind of tale of two worlds, if you will. Like there was a bunch of people who were really excited, saw it as a great solution, have been looking for something like this. I mean, because the other benefit from our angle is we had never really done a fund structure. It had always been one-off deal syndication. And so, if they missed that window of syndication, for instance, right now, like this deal closed around tax time. And so a lot of people were like, oh, I don't have any money because I got to pay like an $80,000 tax bill or something. So I can't invest this month, but give me a couple months and I can invest. And I'd be like, all right, sorry, the deal's already closed and you can't invest. With this new fund structure, this Reg A structure, they have that opportunity. So I think a lot of people who are in that kind of ebb and flow, which is most of our investors. I mean, even the super highly wealthy family offices, they'll sell a property for $50 million and then they won't sell another property for 10 years and they kind of dwindle that money down until it pops up again or something like that, right? So it's not always that, people just have the same amount of money every single month that they can invest. So that gives them the option to do that now. So if somebody says, oh, I paid my tax bill and now I'm ready to invest, because it's a Reg A fund that's open all the time, they can do that today, or they could do it tomorrow or a month from now. So I think a lot of those people were excited to have this opportunity that's kind of always on the table, if you will. But then there were a lot of other people who were, concerned. They don't understand it. It's new. They're not sure how it's going to play out. It doesn't have as much of a tested track record. So I think there were also a lot of people who I think will invest over time, but just kind of weren't the first round of investors because they were like, let's see how you pay out your first couple of dividends and see how it goes. And then we can start to talk. So I think that's been the other probably the larger group of number of people have been in that latter category. The larger check writers have been in the former category, which is luckily enough, way to support the company.
Hey there, Brandon Hall here, CEO of the Real Estate CPA. Many investors, general partners, and limited partners alike only speak to their CPAs once per year during tax season. If this sounds like you are probably paying thousands of dollars more in taxes than you actually need to. In order to minimize your tax liability, you have to take a proactive approach to tax strategy and planning. That's done by speaking to your CPA and implementing the right tax strategies throughout the year, not only once a year. Join us at one of our free virtual workshops to discover top tax strategies general partners and limited partners can be using to reduce taxes. This offer is only available to listeners of the Real Estate Syndication Show. Seats are limited. Sign up for a virtual workshop today by visiting www.therealestatecpa.com/syndication.
Okay, and can you, I guess, explain a little bit about how this is, the like returns are structured, with this as opposed to, a one-off syndication?
Yeah, I mean, so the good news is you can do it however you want. So there's no rules. There's no like you have to do this or we did this and everybody has to. No, you can do anything you can dream of. So just like a traditional syndication, if you want to have a 4-tiered waterfall with a clawback and all the fancy bells and whistles that the public institutions use, you can do that. And if you want to have the simplest deal structure ever and just say like I get 50 cents of every dollar and you get 50 cents of every dollar and that's it, you can also do that, right? It really just comes down to what do you want and what do your investors accept or what do they want. So, in our particular structure, we just did a flat 90-10 split. So there's no multi-tier waterfall hurdles, IRRs, nothing complicated because we felt like it benefits the investor to see a very clear structure that they can do in their head rather than have to get out the calculator or the Excel spreadsheet to calculate and see if, we calculated it correctly or not. And also we feel like, the 90-10 structure, which means 90 cents of every dollar goes to them and 10 cents goes to us. We felt like that's a fair structure because if we hit a home run, they're keeping the majority of the returns. And if we don't do as well as we think we're going to do, we're only participating a little bit in those benefits. So that's how we structured it. But again, that doesn't mean that's how everyone has to structure it. That's just what we chose.
And can you change the structure of it at any time, or is that like set now for the life of this fund?
Yeah, I mean, so my understanding, and again, I'm not a super expert. We just started this in March, like I mentioned, and I've done a lot of research, but I don't know everything. You can change things, but the more drastic of things you change, there has to be exit options given to people who had been in under the old deal because they don't want to be, or you have to give them grandfathered rights so that you can't change kind of things midstream. And usually you have to go back to the government and ask for that to that change. So really like you want to be kind of sure that like the structure you're going in with is the structure you're going to want to keep, which is really why it benefits you to kind of be more broad and more open with what you're offering. And that's, that's good from an operations standpoint because it doesn't pen you into like only XYZ specific thing if you want to do something else. But on the flip side, it's not great because you can't predict the future exactly what you want to do, right? And then when it's super broad, the investors will often say, I don't want to invest with you because I don't even know what that means, right? So a lot of times when you're starting out in syndication, you have one specific deal with one specific structure and one specific time frame, and it's very easy for people to understand so that they go, oh, I don't trust this operator, but I love this deal and it's for a short period of time, I'm willing to take a risk versus like if I come to you and say, oh, this is going to be an investment structure you're going to have for 10 years and you don't trust me, probably unlikely that you're going to be like, oh yeah, let's just go into doing this thing with Mark, right? So I think that's where the other part of the track record that you mentioned, Whitney, is important because you're usually the Reg A structure or the fund structure is going to be much more broad in scope and not be like these 3 properties. It's going to be like any property that generally meets these goals, right? And that's harder to trust people with unless you have a track record.
Okay. And can you go through the process a little bit, or maybe how it differs, purchasing a property, when you have this fund as opposed to doing a one-off syndication?
Yeah, so that was another benefit that I neglected to mention. Great question, Whitney. In the past, it's open up, put a deal under contract, open up a syndication, structure, close it at closing, and hope that you got all the money in time to make that structure work, which is getting, in my opinion, harder and harder to do with the seller's world out there that we're living in. So in this structure, you can open it now. I can start raising money now and not close on a deal for 10 years if I wanted to, right? There's no time pressure one way or the other. And there's also no time pressure to stop raising funds after you've closed on the deal. So we just bought that property I mentioned a couple weeks back in Georgia, and we're still raising capital today for our next deal. So it gives you the ability to kind of always be raising, and gives you a little bit more runway. Now, obviously, when you have a specific deal target and a time frame, it gives you the benefit of it being a little bit more urgent, and people write checks more frequently. What I've discovered, but there's still people. I got $35,000 yesterday from an investor who knew that the deal closed and just wanted to be a part of it. So I think it's a double-edged sword. It helps you out in the sense that you always can raise, and you don't have that same time pressure of the gun against your head with the closing that's imminent, and you have to match the funds with the timing.
Yeah, that's a great point. But something I thought of also is if you don't have a deal or you're not consistently doing deals, but people are continually investing, you're still having to pay them returns, correct?
Great. Yeah, another great point. So you can choose how you treat that. So you can either take commitments and not take actual capital until you're ready to fund the deal. So you could say, hey, sign the paperwork, tell me you want in for this amount of money, that'll reserve your spot. But it also binds you when I call your money that you have to actually write the check. So a lot of people will handle it that way. I mean, in our experience, I have a good enough relationship with most of these large check writers that no one's kind of writing $100,000 or $1 million check and sending it to us blindly and then saying like, oh, like you better put that to work. So we don't have that problem yet. Most of the people who are writing blind checks are smaller check writers, in which case, we use it to build up reserves or to pay down some debts or to do some things that are productive for the investors or investment that help them get a return, as opposed to just sitting cash in the bank doing nothing until I buy the next transaction. But it certainly can be a problem. I mean, a lot of the larger funds, they do have what's called cash drag, which is exactly what you're pointing out, where you have to pay out returns, but you're not even investing. That's sitting in a savings account earning 1% or something like that, right? So we really try to avoid that, and a lot of the fund managers have done a really good job of doing that by not actually drawing the capital in until they have a use for it. Great point. And before we move on to a few other questions before we run out of time, anything else about this fund and Reg A structure that you'd like to tell the listeners? I mean, I think as with all things, like you want to make sure you have a good guide through the process. So, I have a great securities attorney I'm happy to share with anybody. There's a couple others that have done this numerous times. I would definitely say under no circumstances should you hire your regular securities attorney if they have not done this, because paying them to learn it will cost you, I know from experience of other people who have done this, hundreds of thousands of dollars to pay them to learn how to do it for you, when it shouldn't cost anywhere near that amount of money to do this kind of thing. So I think just make sure you're getting the right advice, the right advisors, and the same with audit. I mean, there are people who will charge you, gladly charge you $100,000 a year to audit your fund, and there are people who will charge you $3,000. And the people who will charge you those lower amounts, they don't have the brand name, so there's some trade-off. But they also, in my opinion, the brand name is not worth all that much in this case until you're some super huge company that requires, that other investors require that. So I think just work out, whether it's through me or anybody else, there's plenty of other people who know about this. It's not just me, how to go through that process with the right people, so you don't waste a lot of time, money, going down the wrong path. Great advice. Hire somebody that's done it. Save 100,000. That's yeah, exactly. Valuable show right here. So, Mark, you have 1 minute with somebody. They say, Mark, I know you're successful in this syndication business. I want to get started in it. What's your best advice for them? What do they need to do to be successful in this business and getting started? I think organizational and a plan, I think has been the most, at least for me, and everybody's different, but what's made me successful is just being as organized and diligent and kind of like tenacious as possible. Going after what you want and being able to explain it to others. Cause I think, a lot of times I see people raising money for a deal or even looking for a deal, and they say like, oh, well, we could do this or we could do that or we could do this. And it's like, people kind of just, their eyes glaze over, at least mine do when you kind of don't know. Cause like, as much as I want to help everybody that I meet, if I don't even see a clear path of how to help them or what they're offering or what benefit there is for me if I'm an investor, it's not going to get you anywhere. And so I think one of the things that we've learned the hard way over the years, and I'm not saying we do it perfectly today either, is just trying to be as focused as possible. So when I'm talking to an investor raising capital, I'm saying this is the specifics of how you benefit. This is why you should care. And I think that's probably the most important thing that people forget. They kind of think like, oh, people are excited about the flashy picture of the deal or the returns. And yes, those are parts of it, but you got to stay focused on kind of like, what is it you're after and what are they after, and how can, you guys align that by giving them what they want, kind of thing.
So Mark, broker asked you what's your buying criteria. What is that?
So today we're focused mostly in the Southwest because that's where we've moved the company to. And it's retail, medical office, and multifamily value add. So we buy kind of those assets that are, like most people kind of out there, that are good quality assets in great locations that we can own for the long term, but need a little bit of TLC. So they're not just turnkey, easy kind of stuff, but they're also not in, some back alley of a place that's never going to improve. In the $5 to $10 million category, typically we've done smaller, we've done larger, but that kind of seems to be a sweet spot where we can stay above, mom and pops and below the institutions. That tends to be where we play best.
And what's been the hardest part of the syndication process for you?
Oh boy, so many different things over the year, I guess. I think the hardest part is meeting enough people. Every person I've been lucky enough to meet with, I've usually been able to close and get them to invest. But just finding enough of those people and finding, there's not like a list of rich people that you can just go and call, or people interested in real estate you can just go and call. So I think that aspect has been the most difficult for us. And like I said, we've been very lucky to find some extremely wealthy people that have trusted us, with a great deal of their fortune. But there's always a need for diversifying that capital flow so that you're not kind of beholden to one or two individuals. And that definitely has been the hardest thing, at least for the last, 3-4 years, for sure.
We'll have to have a whole nother show just about that. So what's a way that you've recently improved your business that we could all apply to ours?
Yeah, so part of that focus and things that I mentioned is organizational structure, so sort of process. When we started, and it was just me and my partner, everybody knew how to do everything because it was just the two of us. So there was no analyst, there was no asset management, there was no anything. And so you didn't have time to write everything you were doing down because you were just doing it. Now, as we've grown, I've realized, I sort of neglected that part of my business and just expected people to have the same training I did and have done every single job. But that's not the case anymore. Most of these people have only done the job that they're doing at other companies or here. And so they don't have that same breadth of experience to understand how the interplay happens and what the steps are. So we've really spent a lot of time in the last 12 months kind of organizing the company, even though it's still very small, people-wise, to make processes so that everything kind of has a checklist. And that's, it's been huge because you'd think, steps wouldn't get missed or important things wouldn't get dropped. But no one's perfect. I'm definitely not perfect. And even though I've done something 50 times, if I don't have a checklist, often things will get missed. And that's been a huge scaling kind of factor for our company recently.
What's been the number one thing that has contributed to your success?
Oh, God. My great looks. No, I'm just kidding. I think my sort of lucky network, I guess, or my ability to connect with other people. Sort of like you're doing with this show. Just meeting great people. There's so many great people that are out there willing to help if you ask for it and you're, generous back to them and don't sort of look at this like a take kind of world. But really, I wouldn't be anywhere today if it weren't for NYU or any of these networks that I tapped into along the way. Even in the past companies I worked at, Archstone Smith, one of the largest publicly traded companies at the time, they got bought up and split up into multiple different companies. And in many ways, that was a huge benefit because now instead of knowing a bunch of people at one company, I know 50 people at 50 companies. And that network has stayed really strong and really helped me in many, many ways. And I've obviously helped them too. I'm not saying it's all been for me, but yeah, definitely other people. Like I couldn't have done any of this. And my parents, my partners, my everything. It's been who I've known has been everything.
How have you kept that network so strong?
Yeah. I do like a real estate event that I do a couple times a year where I get a group of them together, just kind of just calling people and just staying connected. I mean, I really genuinely like almost everyone I work with. And so that helps because just calling them to shoot the breeze is enough of a connection. And sometimes I don't even have a good topic to talk about. I just want to catch up with them. But I think, also it's like when you're a nice person and they're a nice person, if you call them up out of the blue and haven't talked to them for 2 years, they're not going to be like, oh, who is this guy? Like, I'm never going to talk to you again. They're like, oh, hey, yeah, I know it's been a long time, but good to hear from you, whatever, so I don't think you need to be perfect. I'm definitely not perfect,
And tell us, how do you like to give back?
Yeah. So partly teaching. I teach at NYU, in the real estate program there. Not full time, obviously. I don't have time for that. I mentor students from my alma maters as well, and I try to help everybody as possible. Through shows like this or other things where I can teach other people how to avoid the mistakes that I made. And then lastly, I started a charity about 3 years ago that's focused on giving back through education, essentially, in some of the most needy areas of the world. So those kind of three major factors. I'd love to do more, but probably more when I retire, actually.
Nice. Well, I appreciate you sharing that. Mark, tell the listeners, how they can get in touch with you and learn more about you.
Sure. Yeah. So propertyincome.com is our website, and mark@propertyincome.com is the easiest email. I have too many to think about right now, but that's the easiest one. Also on all the social media, LinkedIn, Instagram, just my name. So, but Mark at Property Income probably is the easiest way to get a hold of me.
Great. Mark, you've been a great guest. I really appreciate just the value you've added, and I know the listeners have learned a lot, and I have as well. I appreciate that, and I hope the listeners will reach out to you, and I hope listeners will also go to LifeBridge Capital and connect with me. I'm also happy to help you any way I can. Go to the Facebook group, the Real Estate Syndication Show. Join there so we can learn and grow our businesses together and from experts like Mark, and we will speak to you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.